Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, March 22nd, 2023. Hope everybody's having a fantastic day out there. It's kind of gloomy here in central Colorado. Got rain coming down, which I haven't seen that in since September, maybe. Anyways, but like I said, hope everybody else is having a good day. Market did not have a good afternoon after Mr. Powell spoke and informed the world that they were raising rates again by 25 basis points, a whole 0.25%. And the markets took a dump right after that. So it was kind of humorous to watch. I could see him talking on the TV, and I was watching the charts, and they were going. So, all righty. Well, let's go ahead and, let me stop. If it's your first time watching the Liberty Call, please give me some thumbs up, subscribes, shares, follows, all that good stuff. I would greatly appreciate it. All right, let's go ahead and jump now into the numbers for today. Dow Jones finished the day off down 1.63 or 530 points, closed at 32,030. S&P 500 was down 1.66%, closed at 3936. NASDAQ down 1.6%, closed at 11,669. The VIX was up 4.12% today. It closed at 2226. Canada was down 0.62. Brazil down 0.81. Mexico down 0.28. Our friends across the Atlantic over in Western Europe, Germany was up 0.14, UK up 0.41, France up 0.26, Netherlands up 0.76, Spain down 0.44, Italy down 0.12, Switzerland down 0.1, and Portugal down 0.63. Russian exchanges both in the red today. The MOEX down 0.18, RTSI down 0.4. And the overnights in Asia, all green. The Nikkei in Japan was up 1.93%. Australia up 0.87%. New Zealand up 0.58%. Chinese markets, Shanghai was up 0.31%. The Shenzhen component up 0.61%. China A50 up 0.47%. DJ Shanghai up 0.29%. Hang Seng up 1.73%. And no change right now on the Taiwan weighted. All right. So again, not that what Mr. Powell did was unexpected. I was, after all the banking problems in the last couple of weeks, I was expecting that they were going to do 0.25%. But, I don't know why the rest of the market was thinking that, hey, Powell's going to pivot. He's going to institute the Fed pivot. We're going to start either pausing or lowering rates. And I don't know what people were expecting. I mean, I know Scott Adams was talking about this, I think, yesterday, that what should we handle first? Should we deal with the inflation or should we save the banks? Well, if saving the banks involves more inflation, then that doesn't make any sense. I mean, all you're going to do is create this vicious cycle. Now, if the banks fail because due to the or the squishing down of inflation, too bad. Sorry. Now's the time to be moving your money around so you don't get crushed. So don't say you haven't been warned out there, folks. All right, let's go ahead and jump over to today's market recap. Fed lifts rates by 0.25%, keeps forecast for one more hike, says no cuts in 23. All right, let's see what my notes say here. Today, the Federal Reserve increased interest rates by 0.25%, maintaining its forecast for one more hike this year, despite a recent wobble in the banking sector that is expected to tighten credit conditions and help cool inflation. The FOMC raised its benchmark rate to a range of 4.75% to 5% from 4.5% to 4.75% previously. It was the second straight quarter point rate hike since the Fed downshifted from 50 basis point rate hike earlier this year. The Fed said that, quote, anticipates some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, end quote. The Fed kept its benchmark rate forecast unchanged from December, forecasting a terminal rate or peak rate of 5.1% in 2023, suggesting at least one more hike. Markets had expected the Fed to cut rates later this year, but Fed Chair Powell was quick to dismiss those expectations, saying that, quote, FOMC participants don't see rate cuts this year. It's not in our baseline expectations, end quote. The recent wobble in the banking sector hijacked the narrative on monetary policy and fueled much uncertainty about the rate hike path ahead. The collapse of Silicon Valley Bank and Signature Bank has filtered into the Fed's thinking on monetary policy as members acknowledge that tighter credit conditions could support the Fed in its fight against inflation. The FOMC revised its inflation forecast for the year and next year higher, with core personal consumption expenditures price index, the Fed's preferred measure of inflation, forecast to be 3.6% in 2023, up from a prior forecast of 3.5%. For 24, inflation is estimated to slow to 2.6%, compared with the prior forecast of 2.5%. The strength of the labor market that has played a role in keeping core services ex-housing inflation, which drives the bulk of price pressures, is not expected to change anytime soon. The unemployment rate is expected to be 4.5% in 2023, down from a prior estimate of 4.6%, but tick up to 4.6% next year, unchanged from the December forecast, according to the Fed's projections. The Fed's balance sheet, meanwhile, has also come into focus. And I know I've talked about this in recent articles, recent days, come into focus after it began expanding again in the wake of the jitters in the banking system. The Fed's balance sheet now stands at $8.6 trillion, up from $8.34 trillion last month. The dramatic reversal from contraction to expansion in the Fed's balance sheet followed a rise in funding costs and the central bank's new lending facility that sought to support the banking system. The new lending facility allows banks to access loans up to 1 year using qualified assets, including any underwater or below par bonds as collateral. Insane. Yeah, because I see this as just being a really bad idea to continue to make whole all of these banks that are over the FDIC limit. That's not how it's set up. They have no authority to do this. But, the federal government just does whatever it wants these days. So, I guess we'll see what happens. I'm counting on carnage and destruction personally. All right, next up, an article from LouRockwell.com titled, "We've Forgotten That Business Cycle Recessions Are Essential." And this was written by Charles Hugh Smith of his website, of2minds.com. All right, get my notes here. All right. Mr. Smith argues that the belief that no one should ever get hurt in the markets or the economy is unrealistic and overlooks the role of business cycle recessions in restoring the vibrancy of economies and markets distorted by excesses. The global economy has been plagued by excessively easy financial conditions for the last 25 years, resulting in too many marginal structures being built and funded, including malls, retail spaces, office towers, and empty houses and flats, kept off the long-term rental market. Additionally, marginal IPOs, SPACs, and meme stock manias have created excess risk-taking, fueled by near-zero borrowing rates and proliferating opportunities for quick gains. However, the forest fire analogy applies. The occasional lightning strike ignited fire burns away the dead wood that's collected, enabling new growth to obtain nutrients and sunlight. If authorities suppress these naturally occurring fires out of the mistaken belief that, quote, all fires are bad, end quote, the dead wood piles up, and when fire inevitably starts, it turns into a massive conflagration due to the excessive deadwood that is piled up during the suppression of natural fires / recessions. Moreover, the author highlights the zombie economy, which households, enterprises, and entities that cannot survive without continual fresh injections of new borrowing are kept alive. Debt-dependent zombie proliferate, crowding out productive lending and investment, and the great stagnation is the inevitable result of zombie banks being kept alive, zombie corporations being kept alive, and zombie consumers being given more credit to enable more consumption. He argues that recessions are the process that clears the economy of deadwood that chokes off productive growth, and recessions are not fair or just, with previously well-managed companies making a bad bet, previously prudent households losing their discipline, and governments assuming that the flood tide of capital gains taxes would never ebb. So in conclusion, Mr. Smith argues that rather than suppress recessions, we should embrace the discipline they impose as the essential dynamic of productive growth. The greater the quantity of deadwood that has been allowed to pile up, the greater the intensity of the eventual recessionary conflagration. Therefore, a systematic adaptation is essential to prevent the stagnating zombie economy that never recovers, leading to inflation and the resulting conflagration that burns down the entire forest needlessly. All right, so that's some good stuff there. So, it's just part of the business cycle. It's like, we're born, we live, we die. And it's kind of the same thing with the economy. Businesses that are run, with prudent, economic principles, and, they run a good business, they are profitable, they live within their means. I'm talking to you, federal government. Those are the ones that should be successful. Yeah, economies are going to go through and markets are going to go through downtimes. But that's when you flush out all the crap out of the system. But when you start back on the ascendancy again, you flushed all the garbage out of the system. It's kind of like going on a fast. If you fast for 3, 5, 6 days, by the time you're starving by the end of it. But you flush out all the garbage in your system, and you're starting over with a reset. So. All right, one last quick article to go over. What was it titled? It was titled 15 U.S. cities where $100,000 salary goes the furthest. And this comes from Think Advisor magazine. All right, so number 15 is Nashville, Tennessee. So your after-tax take-home pay is about $74,515,000, adjusted for cost of living. That comes out to $77,782. Next up, number 14 is Fort Wayne, Indiana, where taxes average about 22.5%. So your take-home adjusted pay would be about $78,309. 13 is Columbus, Ohio, with a tax rate of about 22.2. Number 12, Jacksonville, Florida, has a tax rate of about 17.8, which gives you an adjusted cost of living of about $79,019. Number 11, Tulsa, Oklahoma. Awesome place. Not really. Has an average tax rate of 20.1. So your adjusted cost of living is $79,527. Number 10, St. Louis, for my friends out there. Hey, Mark, if you're watching, hey. Taxes range about 22.82%, giving your adjusted cost of living about $79,921. Let's see. Number 7, San Antonio. Wonderful place to live, especially if you're up on the north side, up near the foot of the hill country where we used to live. Taxes average about 17.8%. So your adjusted cost of living would only cost you about $80,124. And next up, number 7, Fort Worth is in a tie with Arlington, Texas. They're kind of the same place. I haven't been to Fort Worth since I was a kid in the 80s. And I've been to Arlington quite a bit to go to, Six Flags and baseball games, but not much in Arlington. So anyways, next up, number 6, Houston, one of my favorite cities. It's a great place to live. It's just flat and huge and hot. But with an average tax rate of 17.8, your total take-home pay adjusted for cost of living would be $81,171. Number 5, Lubbock, Texas, comes in with an average tax rate of 17.8. Number 4, Corpus Christi, nice place. Went there once to go watch some AA games for the Astros, the Hooks. It's a nice place down there. A little warm for my taste, but the water's clear. And you can also go tour the Lexington. It's pretty cool. The Lexington was an active carrier. I think it was decommissioned right about the time I joined in the early 90s, but probably the closest you can get to, a aircraft carrier that was, in use while I was serving. And number 3, Oklahoma City has an average tax rate of 22.1, adjusted cost of living, give you the buying power of $85,000. Number 2, El Paso, average tax rate of 17.8. Cost of living adjusted would give you $84,966. And number 1 is Memphis, Tennessee. I lived there for 2.5 months when I was doing my school in the Navy. Way north. Average tax rate is 17.8. And your take-home pay adjusted for cost of living would give you the buying power of $86,444. So, all right. So just some food for thought and a little bit of information for you folks out there. So that's all I had for today. If anyone needs anything from me, if you're panicking about what's going on in the economy or the markets, or you just want to chat, feel free to give me a ring. You can go to dsafinancialgroup.com. All my contact information's there. Hope everyone has a wonderful evening tonight, and I'll talk to you next time. Adios.